If you're thinking about buying a home this year, chances are you've come across a listing that proudly says Assumable Mortgage. And on the surface, it sounds like the golden ticket, especially in today's interest rates. But here's the truth that most buyers miss. Just because a loan can be assumed doesn't mean it's automatically a great deal. Hey there, I'm Bret Johnson, associate broker with Realty Network Group at Real Broker, and I specialize in making real estate really easy. So before you get swept up in that promise of a low rate, let's walk through exactly how assumable mortgages work, what you actually need to qualify, and the one thing that most buyers miss before falling in love with that low rate home. Okay, so what is an assumable mortgage? Well, an assumable mortgage allows you to step into the seller's existing loan. Same interest rate, same payment, same remaining balance. That means if the seller locked in a 2.75% rate, you could inherit that same rate even while new loans are hovering around 6%. So typically FHA, VA, and USDA loans are assumable. Conventional loans, not so much. So here's what trips people up. You're taking over the rate, not skipping the lender's approval process. There's no private handshake transfer. You still have to qualify. So early in your home search, ask the seller or your agent whether the loan is assumable. It can become a real negotiation advantage and help you plan for a financial strategy up front. All right, so what are the benefits of having an assumable mortgage? Well, the big draw is obvious, a significantly lower payment. A seller who locked in a sub 3% rate will almost always have a payment that beats anything a buyer can get today, typically by hundreds of dollars a month. So that can stretch your affordability, it can lower your debt to income ratio, and ultimately make more homes fit your budget. Another perk, assumptions can often come with lower origination fees, which means lower closing costs. So lower rate, lower fees, that equals more breathing room in your monthly budget. So how do you qualify for an assumable mortgage? Even though you're taking over the existing loan, lenders still need to see that you can repay the debt. Think of this as a light version of a normal mortgage approval. Most lenders look for steady income, a qualifying credit score, and a debt-to-income ratio typically under 43%, maybe as high as 50%. And you also need to have a proof of funds that can cover the equity gap. So the equity gap, that's when the seller owes, say, $300,000 on the home, but they're asking $425,000. That means you have to cover the $125,000 difference up front. So you'll need to provide tax returns, pay stubs, bank statements, employment verification, obviously ID. Tell your lender early if you're planning to pursue an assumption so that they can pre-qualify you and keep things moving once you find the right home. Now, a quick reality check, assumptions are not fast. Most lenders don't process them every day, and they don't really have incentive to do so. So timelines stretch anywhere from 45 to 90 days. So if speed is something that you need, it may not be your ideal path. So when does an assumable mortgage make sense? In the right situation, assumable loans can be a huge financial win. They tend to make sense if the seller's rate dramatically is lower than today's. Maybe you have cash that's available to cover that equity gap, or you plan to stay long enough to benefit from those lower payments. The monthly savings outweigh the upfront costs, and maybe lastly, you lower your closing costs with predictable payments. And for sellers having an assumable loan, it's a strategic advantage, especially in a competitive market where buyers are starved for affordability. So assumable mortgages aren't a magic shortcut, but when the stars align, they can give a buyer a real edge. The key is clarity, understanding the process, preparing for the equity gap, and surrounding yourself with pros who've actually handled assumption transactions before. So if you're considering a home with an assumable mortgage, or just wondering whether the loan on your own home could attract more buyers, reach out and I'll help you set up a one-on-one consultation. We'll break down all of your options so that you can make the smartest move possible.